The phrase cheap silver has always been a psychological weapon before it was ever a price description. It trained the public to believe that something essential could remain undervalued forever, that an industrial metal with monetary DNA could be treated like excess inventory in a warehouse. That belief did not come from markets. It came from policy, from paper systems designed to turn abundance into obedience. And now, quietly, without ceremony, that era is ending. Every monetary transition begins the same way. Confidence erodes before prices move. The story breaks down before the chart does. Silver has lived for decades inside a narrative cage, one reinforced by futures curves, by paper supply that never intended to deliver, by a price discovery mechanism that rewarded leverage over ownership. Cheap silver was not an accident. It was a feature. A low, visible price stabilized currencies, subsidized industry, and discouraged the public from questioning why a monetary metal behaved like a disposable input. History never removes these systems gently. When silver was pushed out of formal money, it did not disappear. It went underground. It became the silent hedge of households, the forgotten asset in vaults, the metal that survived because it did not need permission. Each cycle followed the same script. Long periods of suppression, cultural amnesia, then a sudden failure of control when physical demand no longer responds to paper incentives. What has changed now is not sentiment, it is structure. For years, analysts argued about price targets while ignoring flow. They debated charts while inventories quietly thinned. They trusted reported stockpiles without asking who could actually access them. The silver market was treated as infinite because contracts were infinite. But contracts do not solder circuits. Contracts do not coat solar cells. Contracts do not move when trust breaks. The modern silver market is built on a fragile assumption that futures liquidity can substitute for metal. That assumption holds only when holders believe they will never need delivery at the same time. Once that belief cracks, paper volume becomes irrelevant. The system does not reprice gradually. It gaps. It rations. It chooses who gets metal and who gets cash. A price floor does not announce itself. It emerges when selling pressure exhausts itself against real demand. For decades, any dip in silver invited paper shorts, who knew central banks preferred stability over volatility. The trade worked because physical buyers waited. They trusted lower prices tomorrow. That behavior has reversed. Today, dips are treated as supply events, not trading opportunities. The metal does not come back to market once it leaves. It disappears into long-term hands that are no longer price sensitive. This is how price floors are born. Not from regulation, but from refusal. When producers hesitate to sell forward at levels that do not cover rising costs. When refiners prioritize strategic customers over exchanges. When sovereign buyers stop announcing purchases and simply accumulate. The visible market shrinks while demand remains. Volatility increases not because of speculation, but because liquidity is gone. The phrase cheap silver collapses under its own logic when energy, labor compliance, and capital all reprice higher. Mining does not exist in a vacuum. It exists inside the same inflationary pressures that distort everything else. A metal cannot remain cheap when the system extracting it becomes expensive. At some point, the price must reflect reality or supply fails. That moment is not ideological. It is mechanical. There is also a psychological threshold that markets cross only once. For years, silver was framed as optional, a speculative curiosity, a trade. Now it is being reframed as strategic, essential, non-substitutable. Once a commodity is mentally reclassified, it does not return to its old valuation framework. Oil never went back to being cheap after it was understood as geopolitical leverage. Gold never returned to its pre-monetary exile once trust in currencies began to fracture. Silver is following the same path, later but faster. The hidden economy always moves first. It is where signals appear before narratives adjust. Leasing rates tighten. Delivery delays lengthen. Premiums detach from screens. These are not anomalies. They are early warnings that the paper price is losing authority. When a market must bribe participants to stay liquid, control is already slipping. A price floor in this context is not a guarantee of upside. It is a boundary of stress. Below it, the system bleeds inventory. Above it, the system survives another day. Authorities do not need to announce intervention for it to exist. The incentives do the work. Volatility becomes asymmetric. Drops are shallow and brief. Rallies are violent and confusing. Analysts call it irrational because their models were built for a world that no longer exists. The end of cheap silver is not about optimism. It is about consequence. Decades of treating a monetary metal as expendable created a structural imbalance that cannot be solved with narratives or derivatives. The market is being forced to reconcile price with function. That reconciliation is never smooth. When historians look back, they will not point to a single headline or event. Cheap silver was never a market reality. It was a policy illusion sustained by paper promises that no longer command trust. From the moment silver was pushed out of formal monetary circulation, it did not lose its function. It lost its narrative. The public was taught to see it as surplus, as a relic, as something technologically useful but economically irrelevant. That story served a purpose. A metal that once anchored trade, wages, and savings had to be psychologically neutralized in order for unbacked systems to expand without resistance. Cheapness became the proof of irrelevance, and irrelevance became the justification for neglect. Markets did not arrive at this condition organically. Silver did not become abundant because nature changed its mind. It became cheap because its price was discovered in a venue designed to maximize leverage rather than ownership. Paper contracts multiplied far faster than physical supply, creating the impression of endless availability. The promise to deliver became more important than delivery itself. As long as participants believed those promises were interchangeable with metal, the illusion held. Price was not set by scarcity or utility, but by confidence in settlement. This confidence was never rational. It was habitual. For decades, the market functioned on the assumption that most participants would never ask for the thing they were trading. Silver became a number on a screen, a derivative of a derivative, abstracted from weight, purity, and location. The lower the price went, the more it reinforced the belief that there was no urgency to own it. Cheap silver trained patience, and patience allowed the system to continue. Policy benefited enormously from this arrangement. A subdued silver price lowered industrial input costs, reduced inflation signals, and supported the broader credibility of fiat currencies. A monetary metal screaming scarcity would have raised uncomfortable questions about purchasing power, debt, and trust. Silence was preferable. So mechanisms evolved to dampen volatility, absorb demand, and reroute stress into paper markets where it could be netted, rolled, or delayed. But illusions are only stable when behavior cooperates. The promise-based system required that holders of paper silver remain content with exposure rather than possession. It required that producers hedge forward regardless of margin compression. It required that industrial users assume just-in-time delivery would always work. Most of all, it required that no one treat silver as insurance again. That condition is now failing. The shift did not begin with price. It began with credibility. Delivery times extended. Inventory classifications blurred. Leasing rates signaled tension that official narratives dismissed as noise. Premiums began to separate from quoted prices, revealing a quiet two-tier market. These were not anomalies. They were stress fractures in a system that relied on indifference. Once trust weakens, paper abundance becomes a liability instead of a strength. Every contract is a promise, and every promise invites scrutiny. The more claims that exist relative to available metal, the more fragile the structure becomes. In such an environment, cheapness is not reassurance. It is a warning. It signals that the price is no longer doing its job of allocating scarce resources. History shows this pattern repeating with relentless consistency. When a monetary asset is suppressed long enough, it does not fade away. It accumulates tension. Public interest disappears, but private accumulation increases. The market becomes quiet, then brittle. When the break comes, it is not because demand suddenly appears, but because supply vanishes. Sellers step back, holders reassess. The flow that once masked imbalance dries up. Cheap silver could only exist while sellers believed the price would recover later, or that alternatives would emerge, or that policy would always intervene. As costs rise across energy, labor, and capital, those beliefs erode. A producer cannot sell indefinitely below the full cost of replacement. An industrial buyer cannot assume infinite elasticity in a world of constrained logistics. A sovereign cannot ignore the strategic implications of dependency forever. The illusion also depended on memory loss. Societies that forget why metals were money are easier to manage with promises, but memory has a way of returning during periods of stress. When confidence in institutions weakens, people rediscover old tools, not out of nostalgia, but necessity. Silver does not need marketing to matter again. It only needs doubt to spread. What breaks policy illusions is not rebellion, but arithmetic. Promises accumulate. Obligations compound. At some point, there are more claims than credibility. When that threshold is crossed, paper instruments cease to call markets and begin to expose them. The price no longer reflects comfort, it reflects strain. The end of cheap silver does not require dramatic announcement. It reveals itself through refusal. Refusal to sell at uneconomic levels, refusal to roll contracts indefinitely, refusal to believe that a digital claim is equivalent to a tangible asset. Each refusal removes liquidity. Each removal raises the minimum price required to coax metal back into circulation. This is why cheap silver was never real. It was a temporary condition engineered. Price floors are not declared. They emerge when physical metal refuses to return and paper liquidity loses authority. They are not created by speeches, regulations, or official announcements. They form silently, through behavior, through absence, through the growing gap between what is quoted and what can actually be obtained. A true price floor is not a line on a chart. It is a boundary of exhaustion where the market discovers that below a certain level, supply simply stops cooperating. In paper-driven markets, liquidity is treated as a substitute for reality. Volume becomes proof of health. tight spreads are interpreted as stability. As long as contracts trade freely, it appears that price discovery is functioning. But this appearance depends entirely on confidence that the underlying asset can be delivered if asked for. When that confidence weakens, liquidity becomes cosmetic. Trades still occur, but authority drains out of the system. Physical metal operates under different rules. It does not respond to narratives or positioning. It moves according to incentives, costs, and trust. When prices fall below levels that justify extraction, refinement, transport, and risk, physical holders do not rush to sell more. They do the opposite. They retreat. They wait. They conserve. This is the first stage of a price floor, and it is invisible to those watching only screens. Historically, every durable floor has emerged this way. Sellers stop showing up. Inventories that were assumed available reveal themselves to be spoken for, leased, pledged, or simply unwilling. The market does not collapse downward. It stiffens. Volatility compresses on declines and expands on advances. Analysts misread this as consolidation, unaware that the character of the market has changed. Paper liquidity loses authority when it fails its primary function, which is to clear supply and demand honestly. In a healthy system, lower prices attract sellers, and higher prices attract buyers in a continuous exchange. When paper markets dominate, this mechanism is distorted. Lower prices attract more paper selling, not more physical supply. The feedback loop becomes self-referential, detached from the underlying asset. This works only as long as physical holders remain indifferent. Once indifference turns into caution and caution turns into refusal, paper liquidity becomes stranded. Contracts can change hands endlessly without inducing new metal to appear. The market still trades, but it no longer equilibrates. This is when a floor begins to assert itself, not through defense, but through absence. The most misunderstood aspect of price floors is that they are formed by sellers, not buyers. Buyers can be enthusiastic and still fail to lift a market sustainably if sellers remain eager. Floors emerge when sellers decide the price is wrong and act accordingly. In physical markets, this decision is often collective but uncoordinated. Each participant responds to the same pressure, rising costs, declining trust, strategic reassessment, and arrives at the same conclusion independently. Costs matter more than opinions at this stage. Energy inputs, financing, regulatory burden, and opportunities cost all feed into the minimum acceptable price. When the market price falls below that threshold, supply does not increase to meet demand. It contracts. The system begins to consume inventories instead of replenishing them. That drawdown is the hidden signature of a forming floor. Paper markets attempt to override this process by manufacturing liquidity. More contracts, more leverage, more synthetic supply. This can delay the adjustment, but it cannot reverse it. Synthetic supply satisfies only synthetic demand. Real demand, the demand that requires delivery, tests the system. Each test removes optionality. Each delivery tightens the remaining float. Over time, the paper price becomes less capable of pulling metal out of hiding. Authority in markets is ultimately about credibility. A price is authoritative when participants believe it reflects reality closely enough to base long-term decisions on it. When producers hedge less, when refiners prioritize relationships over benchmarks, when buyers pay premiums without hesitation, authority has shifted. The quoted price still exists, but it no longer commands behavior. That is the definition of lost authority. At that point, floors stop being theoretical. Attempts to push prices lower encounter resistance not in the form of buying enthusiasm, but in the form of selling apathy. There is nothing to hit. Offers thin out. Liquidity evaporates at the lows. Each downward move becomes shorter, sharper, and less effective. The market begins to reject lower prices, not emotionally, but mechanically. This process often confuses observers because it lacks drama. There is no single event to point to. Instead, there's a growing sense that the market is harder to move down than it used to be. Rallies overshoot. Pullbacks fail early. The old playbooks stop working. Participants who rely on paper signals find themselves repeatedly mispositioned. Price floors born this way are resilient because they are rooted in real constraints. They do not depend on continued optimism. They persist even when sentiment is negative. In fact, they often form during periods of pessimism, when public interest is low and when a monetary metal is reclassified as strategic, not speculative. It never goes back to its old valuation regime. This transition does not happen through marketing or mass consensus. It occurs quietly, inside institutions, supply chains, and balance sheets, long before the public narrative adjusts. A speculative asset is something traded for return. A strategic asset is something held for security. Once that distinction is made, behavior changes permanently, and markets are shaped by behavior far more than by opinion. Speculative demand is elastic. It responds to momentum, headlines, and opportunity cost. It enters easily and exits quickly. Strategic demand is the opposite. It is patient, deliberate, and largely insensitive to short-term price fluctuations. When silver, or any monetary metal, begins to attract strategic holders, it is removed from circulation for reasons unrelated to price appreciation. It is held to ensure processes, systems, or sovereignty. That metal does not come back to market simply because price rises or falls. Its function has changed. History shows that metals cross this threshold during periods of systemic stress. When trust in financial intermediaries weakens, assets once considered optional are reevaluated through a different lens. The question shifts from how much can be made to what must be protected. At that moment, valuation models based on marginal trading activity become obsolete. Strategic holders do not consult charts to decide whether to retain a critical input or reserve asset. They consult risk assessments. This reclassification alters supply dynamics in a way that cannot be reversed by sentiment alone. In a speculative regime, high prices cure high prices. Supply responds. Holders sell, new projects are financed. In a strategic regime, high prices do not necessarily unlock supply. Holders may increase their reserves precisely because price signals scarcity or instability. What would have been an incentive to sell becomes a warning to hold tighter. The silver market has lived most of its modern existence in a speculative framework imposed by policy and reinforced by paper trading. It was priced as though its primary role was investment curiosity or industrial input, not monetary ballast. This framing allowed vast quantities of paper claims to stand in for metal and encouraged the belief that any shortage could be resolved by price alone. That belief depends on metal being willing to flow. Once silver is viewed as strategically essential, that assumption collapses. Industrial users begin to think in terms of assured access rather than lowest cost. Governments and institutions consider stockpiling rather than sourcing on demand. Long-term holders prioritize control over liquidity. Each of these shifts reduces the amount of metal available to satisfy marginal loss possible, and the mental model. Once the metal is seen as strategic, selling becomes a risk decision, not a profit decision. That mental shift alone raises the clearing price, because the market must now compensate holders not just for opportunity cost, but for relinquishing security. Valuation regimes are reflections of collective priorities. In a speculative regime, price oscillates around perceived fair value, anchored by trading flows. In a strategic regime, price becomes a function of replacement difficulty and systemic importance. These are not linear variables. Replacement difficulty can change abruptly when supply chains strain. Systemic importance can jump when alternatives fail. The price must adapt to these realities, often violently. No market has ever willingly returned a strategic asset to speculative status without first resolving the risks that prompted the reclassification. Gold did not revert to a mere commodity after monetary crises highlighted its role. Energy did not return to being just another input after it became a tool of statecraft. Once silver begins to be treated as a strategic resource, its valuation is anchored to resilience, not abundance. This shift also exposes the limits of paper pricing. Paper markets excel at facilitating speculation. They are less effective at serving strategic accumulation, which requires certainty of delivery and control. As strategic holders withdraw from paper channels, liquidity thins. Price signals become less reliable as indicators of true availability. The market enters a phase where quoted prices lag reality rather than lead it. Public reception usually lags this process by years. The narrative of cheapness, volatility, or irrelevance persists long after institutional behavior has changed. This lag creates confusion. Observers see price movements that seem disconnected from fundamentals because they are using outdated frameworks. They interpret strategic accumulation as irrational hoarding or manipulation, not recognizing that the rules have changed. The permanence of this transition lies in the fact that it is driven by memory. Once institutions experience shortage, delivery risk, or dependency, they do not forget. Risk models are rewritten. Procurement strategies are redesigned. Even if conditions temporarily ease, the lesson remains. Strategic classification is rarely rescinded. It is institutionalized. As more metal is held for reasons unrelated to trading, the market becomes thinner and more reactive. Small imbalances produce large price movements. Volatility increases, but not in the random way associated with speculation. It becomes directional, punctuated by sharper repricings when reality asserts itself. This is why old valuation regimes fail. They assume liquidity that no longer exists and willingness that has been withdrawn. They assume a market eager to sell into strength and buy into weakness. Strategic holders do neither. They accumulate quietly and release reluctantly, if at all.